Best Inflation-Proof Investments for 2023. By StockCryptoBonus.com. Investing during high inflation is challenging, yet possible. When inflation is high, it erodes the purchasing power of your investments and savings, making it difficult to protect your finances. While it may be intimidating, there are several strategies investors can use to protect their investments from the effects of inflation. The first strategy to consider is diversification. By diversifying your portfolio, you can spread your risk among a variety of different investments with varying levels of risk. This allows you to make more educated decisions about your investments and diversify into different asset classes that may not be affected as heavily by inflation. For example, if inflation is rising, an investor might consider investing in commodities such as gold or silver, as these tend to increase in value as inflation rises. Another strategy for investing during high inflation is to stay on top of current economic conditions and adjust your investments accordingly. This means regularly monitoring the rate of inflation and adjusting your portfolio in response to changing conditions. The Bureau of Labor and Statistics, BLS, said on November 10 that the Consumer Price Index, CPI, had gone up by 7.7% in the past year. That was 0.5% less than September's rate of 8.2%, but it's still much higher than the Fed's target rate of 2%. So, how do you find investments that gain value instead of losing it due to inflation? Here are some investments that are safe from inflation. Consider these investments that are safe from inflation. The combination of the fast return to the level of economic activity before the coronavirus crash and the trillions of dollars the government spent to boost the economy created the perfect storm for inflation to speed up. When it comes to investing for inflation, there are no sure things. Some investments may be safe from inflation, but you can never be sure of a return. Still, any one of the following asset classes or a mix of them could be a good choice. I-bonds. I-bonds are an excellent way to invest in 2023 if you want to take advantage of inflation. The interest on these U.S. savings bonds is based on a fixed rate of interest and the rate of inflation. The result is an investment that is almost risk-free and is backed by the U.S. government. It is a great way to protect your money from inflation. I-bonds are paying out a decent rate right now. Series I savings bond is at 6.89%. For savings bonds issued November 1, 2022 to April 30, 2023. I-interest on bonds adds up every 6 months. Just remember that you can only buy $10,000 worth of I-bonds each year, and you can't buy them through your online broker. You have to go to treasurydirect.gov instead. The least you can spend is $25. If you don't cash out your I-bonds before 30 years, they will continue to earn interest. But you have to hold on to the bonds for at least a year. If you take out the money before 5 years, you lose the interest for the last 3 months. Store cash in money market accounts. Putting your extra money in a money market account is another popular way to invest during times of rising prices, MMA. Here are 2 examples of why this is the case. Money market account rates change all the time with interest rates, and they go up automatically when interest rates go up. There's no need to look for investments that pay more than cash. Since money market interest rates rise with the market as a whole, you won't lose market value like you would with fixed-rate investments when inflation is high. When inflation hits, you need to put your money in interest-bearing investments like money market funds. Even if you do this, you are still losing money to inflation. But it's still better than leaving your money in a checking or savings account that doesn't earn much interest. Real estate is still an option. Long-term, real estate is also usually a great way to protect your money from inflation. Real estate is the best kind of hard asset, and its value often goes up the most during times of high inflation. This is especially true because as rents go up, more and more people want to buy their own homes so they can get the tax breaks that help make up for inflation. You don't even have to be a landlord to invest in this class of assets. In fact, you can invest in income-generating real estate through real estate crowdfunding sites, and some of them only require $10 to get started. We like options like Fundrise because it pays dividends every 3 months and only costs 1% per year to run. But you can protect yourself from inflation by putting some of your money in real estate through these companies. You can also use a platform like Roofstock to invest directly in individual properties. But you can also invest in real estate investment trusts, REITs, like the Equity Residential (EQR) Trust. This trust owns more than 300 large apartment complexes, most of which are in high-cost areas like New York, Boston, San Francisco, Southern California, Washington, D.C., and Seattle. No matter how you do it, you should have some real estate in your portfolio if you think inflation will go up. You may want to avoid long-term fixed-income investments. During times of inflation, long-term investments with fixed interest rates are the worst place to put your money. These can be any fixed-rate interest-paying debt securities, but especially those with terms of 10 years or more. The problem with long-term investments that pay a fixed income is that when interest rates go up, investors flee the investment in favor of ones that pay a higher yield. If interest rates on new 30-year bonds went up to 5%, the value of that bond that pays 3% could drop by as much as 40%. When inflation and interest rates are going down, long-term fixed-income investments are great. But if you think inflation is about to get out of hand, you should move your money out of long-term fixed-income investments and into other, shorter-term options like money market funds. Consider growth stocks and funds. Many investors try to balance their stock portfolios by buying stocks with high dividends or investing in growth and income funds. This can work well when prices are stable. But when inflation goes up, it can hurt the returns on your investments. At least in part, this is because stocks with high dividends are hurt by rising inflation in the same way that long-term bonds are. The better alternative is to put most of your money into stocks and funds that grow. You should also focus on areas that are likely to do well when prices go up. Some of these are energy, healthcare, food, technology, building materials. Since all of these things are likely to get more expensive as inflation rises, they are likely to do better than other equity sectors. You can invest in these areas through an exchange-traded fund, ETF, or by buying stocks with growth potential. For example, the S&P Oil and Gas Exploration and Production ETF, XOP, and the Vanguard Healthcare Index Fund, VHT, are two ways to invest in energy stocks, VHT. Commodities may do well during periods of high inflation. Even though there isn't a direct link between price levels and commodities, inflation has always been good for certain hard assets. The first things that come to mind are precious metals, especially gold and silver. You can hold precious metals directly in the form of coins or bullion bars, or you can invest indirectly by buying gold-backed ETFs. You can also invest in companies that mine gold or in funds that hold these companies. But these are shares of the metal, not the metal itself. They also tend to be very unstable, even when the price of gold is going up. Energy stocks and funds are likely to be a safer hold on the stock side. This is especially important because one of the main causes of inflation is often a rise in the price of energy. If you want to invest in commodities, you should open an account with one of our best brokers. Once you have an account, most full-service brokerage firms let you trade directly through a futures fund, options, or an ETF. Alternative asset classes. If you're still not sure what to invest in when inflation is high, you can look into different types of alternative assets. This can also be a smart move when markets are down, since many alternative investments don't correlate strongly or at all with general markets. You can also look into alternative investment platforms like YieldStreet, which lets you put as little as $2,500 into a variety of funds and deals. Just keep in mind that some of these platforms require you to be an accredited investor and can have higher minimum investment requirements. But alternative assets are something to think about if you want to spread out your investments and maybe protect your wealth from inflation. Convert adjustable rate debt to fixed rate debt. Technically, this is not an investment move, but it could be one of the most profitable things you can do to deal with rising prices. When you borrow money, adjustable rates are better than fixed rates when inflation is low or going down. But the trend changes when inflation goes up. Higher inflation leads to higher interest rates, so as inflation goes up, your adjustable rates will keep going up, maybe even to levels that you can't afford. If you think inflation is on the way, you should start changing your variable rate debt to fixed rate debt. This should include credit cards, home equity lines of credit, and especially your first mortgage if it is an adjustable rate mortgage, ARM. Talk to the company that gave you the loan to find out what options you have. It's also a good idea to look at your loan paperwork to find out when your rates will go up so you can plan ahead. If you refinance your mortgage, try to shorten the length of time you have to pay it back and don't reset your 30-year mortgage. Even if your monthly payments stay the same or go up, you will pay a lot less in interest in the end. Bottom line. As the Federal Reserve relaxes its monetary policy and starts to raise interest rates, the hope is that inflation will eventually level off and start to go down. That will take time, though. Repositioning is important right now. Adding just a few investments that tend to do well in times of high inflation could help your portfolio survive and maybe even grow during this time of out-of-control inflation. This video originally appeared as an article found at StockCryptoBonus.com. Read more articles like it and get more information, tips, and advice about the stock and cryptocurrency markets at StockCryptoBonus.com. Remember that the price of investments may vary depending on changing market conditions. Don't forget to subscribe and click on the bell icon to get notification to get our latest videos on big investing and financial topics of the day.